In ET Now Top Market Voices, segment. Well, let's decode the market move and let's also try and understand what's next for India. We're asking the question as to how the global trend is impacting India's story as well. Ajay, actually, my colleague spoke with Sailesh Bhan of Nippon MF, S. Naren of ICICI Prudential Mutual Fund, and SBI Mutual Fund's Srinivasan Rama-Iyer during the CFA India's 14th conference. Listen into a slice of that conversation.
See, internationally, there are so many moving parts that it's very difficult to say where it stands. It's clearly, it means that the volatility reflects, or at least the unidirectional movement reflects that clearly a lot of it is getting priced in. We don't know the degree of it, and neither does it reflect on the fact that it will immediately correct. None of these lead to that conclusion. In India, clearly we are finding that expectations are running very high, and I think. So whether we are in terms of scale where we stand, but clearly we are getting into a zone where you touch a stock, it goes up. You don't need to read about it or invest or whatever, or you think about it, it goes up. So that is a reflection of, I would say, starting of excesses, which is there now for the last few months. Money flows are unidirectional. Everybody's turned into, or everybody has a stock idea today. So clearly we are getting into that zone. And that is where I think a little bit of risk averseness will help all of us.
Great, you are spelling out caution. That's a great starting point. Vasu, just to put the global things also in perspective, from the peak of pessimism, COVID lows, there's a lot of things happened. Geopolitical issues, in the Middle East, slowdown issues in the US. China is not doing that great, but markets globally have been climbing, not all markets, but largely this wall of worry. What do you make of the backdrop, global backdrop in which India is operating right now?
I wouldn't have been able to predict this if you had asked me this question.
Say 2 years
and if
back.
you had 2 years back, and if you had told me there's going to be a war and all the uncertainty and rates would have gone up to like 5%, I would have definitely been negative on markets. So I think the only thing that explains it, I guess, is the huge liquidity around.
Because I don't remember a time when
also.
War is going on simultaneously, market is running globally. As if everything is getting priced in. And the global asset classes are moving in individual silos, and a war in the Middle East did not really impact for a prolonged period of time. It did impact for some time temporarily, but then market moved on. So how did you react at that time? And were you also, your model also kind of you got surprised?
So it's easier for us to be very honest. So we are relative return investors. So we really don't bother about where the market is going largely for a very large part of the portfolio. We just put our heads down and try to figure out what stocks or sectors will do well within that frame. So that makes our job easier. But having said that, we do have a market timing model on which we run a dynamic asset allocation fund. That model has been negative on equities for like the last 18 months or so. And by and large, I would say that model has gone right because the underlying for that model is the Nifty. And till the recent rally, Nifty really hasn't gone, I mean, it's done like 5%, 6%. But what has really done well is the stocks down the capitalization curve. And the model doesn't try to predict that because the data there is not clean enough. And the model has been negative because while earnings are good, so we basically look at three factors: valuation, earnings, and sentiment. Earnings are fine. I think they're better than expectations for sure. Valuations, we look at something called the Shiller P. We look at the inverse of the Shiller P, and we take out bond yields from it. So that's somewhere in the 77th or 78th percentile. And when you kind of regress that with 3-year forward returns indicate an equity risk premium of like 1.25, 1.3%, which I think is not good enough. You need closer to 5.5%, 6%. And we also kind of put sentiment on top of it. So the sentiment index we run correlates very well with 1-year forward returns. We do that because markets tend to overshoot on the upside and on the downside. So you want to kind of time it right. So this model has been negative. It also, the extent to which it has been negative is, so on a 50-50 benchmark, it's been 20% underweight equity. And I think it's been fine so far. So I would say that to that topic, optimism or exuberance, right? So I would say that large cap space is probably in an optimistic zone, whereas I definitely think that The small cap, the micro cap space is quite exuberant.
Okay, so you're breaking it down in two parts and approaching the market.
Because that dispersion is very visible.
Very
so small cap index is done 50%, large cap is up like 17, 18%, 30, 32% outperformance in a year. So,
Naren, the speed at which global fear turned to greed, when we topped out, say, 107 on the dollar index globally, or yields, from the recent peaks have fallen below the 4% mark. Were you surprised at which the sentiment globally also changed? That also gave a very big kind of boost to Indian equities.
Certainly, I think people have come to a conclusion equity is the only asset class which people like today. First of all, it's a liquid asset class. You can easily come in and come out. The trading engine is very good.
You're talking about global equities?
Yeah, even globally. So somehow what has happened is that people have found it very comfortable with equities as an asset class. And I think globally there are too many people who have short positions in too many stocks. So what happens is that periodically the shorts get squeezed. And that also results in huge rallies these days. There are these CTA funds globally. I think those funds manage to squeeze out all the shorts periodically. So I think, there is all kinds of market positions these days, things which we don't know about actually, and that has resulted in a situation where it has become very difficult to predict markets at this point of time. And the kind of whipsaw moves that you have on small differences in results are something which you would have never expected way back, because of the fact that you have what kind of short position, who has the short position, we don't even know. And that is, so that's why I would say yes, we have been surprised, but we have increasingly got round to the view that there are a lot of people for whom this has been a long bull market in US, all the way from 2010 to 2021. So I think a lot of people believe in equities as an asset class. Even in India, if you look at it from 2013 onwards, most people have not seen losses. So people believe in equities as an asset class. So the confidence in equities is at a record level that people don't want to leave the asset class. So periodically what was trading at X.
So what people were trading at one point of time, they have actually changed. So slowly every PE, what you were giving XP, you started to give 20% higher valuation. Now slowly you're giving 30% higher valuation. You're giving 40% higher valuation. I think every other boom continues, you'll give higher and higher valuation. So then the market boom can sustain.
What is your view on this argument which comes up that some of the reason for India's strong outperformance is actually because of the superior economic growth over here and structural reforms which have been taking place versus many other large liquid markets globally?
Absolutely. I think the macro has been handled very well over the last decade. If you look at current account deficit, for example, has been very well behaved. Inflation has been very well behaved. The interest rates in India are much lower than where they were 10 years back. So on all those counts, there is an argument for value for the entire macro to be good. While macro is good, increasingly, to what extent you will pay what valuation. Because if you look at many parts of the economy, there are many sectors in the economy which are growing much slower than before. But while those sectors are growing slower, you're giving now higher valuations. So yes, the macro is good, but how much extra valuation you'll give for the macro? That is the challenge that we as investors. So to the extent you can forget the past, it's easier to manage money. And how much you forget the past, because finally the past will come back. So that is the challenge that we have when we have to look at investors' interest when you are managing the money.
Yeah, and they say about history that the only thing we learn from history is that we don't learn anything from history.
Exactly. So if you ever had a mindset of looking at a company with a pre-2013 lens, it would be very difficult to invest in any stock. So you have to have a new lens. Whether that new lens is a wrong lens or not, you'll come to know, and that's the challenge for us at this point of time.
Sailesh, what happened was that from a time, say 2 years back, there were some economists out there who were saying that India will be lucky to have 5% kind of growth. the kind of numbers which we saw surprised majority of the investing population in universe. Does the economic growth which we've been posted in the last 2 quarters, say, does it appear sustainable or prolonged to you?
Clearly, growth rates are improving, right? So the debate on valuations is more that whether that all that
How much
growth
of that is priced in?
Yeah. So growth rates are improving clearly, and despite the world being in bad shape, we are coming back. Only worry is, the revenue growth hasn't kicked up so strongly. It's more coming from margin expansion, from generally sharp fall in raw material prices versus what was the case 12, 18 months back. So the base effect is flowing in. As revenue growth starts kicking in, which I think is possible in the next 1 or 2 years or a few quarters ahead, I think things should get okay from a growth point of view. But we are already paying for, at least in a lot of pockets, like, the small and mid-cap kind of sub-pockets, we are certainly paying well. So there cannot be any room for error. There cannot be any disappointment, which is, see, today it's a belief of certainty. So investor is writing a check with a certainty of returns in mind, or at least the expectations are a little unreal. So that is where the word of caution. Broadly, markets can still do, earnings can still do well and things like that. That's not a problem so much because balance sheets are good, reforms have happened, macros are decent, our currency is not fragile, at least as it used to be earlier. So it's much, much better from that angle, and the runway for growth can certainly be long, but I think we are paying a little too
already
upfront because of the
price.
flows which are happening.
Also, what are your thoughts on, 2 largest economies in the world? And, we have been kind of at the receiving end of volatility in commodity prices for a very, very long time. Corporate India suffers from it. We as consumers also go through those challenges. But the 2 large consumers, apart from us, for commodities have been US and China. Both of them are in not great economic shape. Does it give you confidence that the commodity universe will remain in deflationary trend for medium term? Because that eventually will have impact on the raw material scenario for corporate India and hence will kind of cushion margins. China and US.
That is definitely one way to look at it. But we're actually bullish on commodities from a longer term perspective. Basically, the long term view is that because of the high debt to GDPs across the world, you are entering into a phase of, or a period of financial repression, and negative real rates will be positive for commodities.